Markets have been anything but calm this year. Volatility is back. Headlines are on a 24-hour news cycle, and investors are scratching their heads wondering what to do. There is a light, however. Beneath the noise, some companies are quietly building real value, and all within the context of megatrends. We're going to discuss that and a whole lot more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. My guest in the studio is Eli Horton, Senior Portfolio Manager from TCW. Eli, nice to have you here in the studio with me. Good to see you.
It is great to be here. Thanks for having me.
Yeah, I mean, look, there's always a lot going on in the markets these days. We were just talking, you never know what kind of headline you're going to wake up to in the morning, whether it's a tariff headline or something happening in the markets or something happening in the world, but it affects our day-to-day jobs and our investing lives, right? So it certainly has been an eventful year. I mean, I kind of mentioned the tariff situation and the current administration, but we're seeing volatility at levels we haven't really seen since 2020, especially after Liberation Day in April. We've got this risk-off environment that's happening. Then there's this bit of recovery, and we're not even talking about bonds today, but yields have really been all over the map. Maybe you could start by giving us a little bit of a recap from where you're sitting and how you're sort of looking at what's really happening out there.
We're 5 months into the year, and already what a year 2025 has been.
That's right.
It's been
That's
pretty
exactly
wild.
Right.
I mean, you mentioned volatility. We've seen the VIX index spike north of 50. We've actually seen quite a bit more volatility in the public equity markets than we've seen in years. Candidly, I think that's a great thing for investors, by the way. I think the question is, why is there this type of volatility? And I think you can trace it back to uncertainty. And we've almost had some man-made uncertainty thrown in. Really in the form of tariffs, which you mentioned. What have the tariffs created from that uncertainty perspective? Well, one, created some uncertainty around future growth. Two, they created some uncertainty around, is inflation back? And you hear the word stagflation thrown out quite a lot. What this has led to is just very heightened policy or economic policy uncertainty in the minds of investors, and not always knowing what the rules are by which the game is played. And it seems those rules change on a daily or hourly basis at times. When that happens, the market says we need a higher discount rate for future cash flows. You see that in the multiples of stocks, which a few months ago were hammered. Market was down 19% from peak, I believe. And now we've almost retraced all of that. So quite a wild and bumpy ride so far.
And as you said, in a very short time period. I mean, it's 5 months of the year, but when it was really the volatility really picked up, and we saw steep declines in the S&P when Liberation Day happened on April 2nd. So it's only been really 2 months that we've gone down to, multi-year lows, and now we're sort of flat again.
It's interesting, isn't it? That's not normal, but
right.
It's almost like we're becoming conditioned to these fast recoveries and sharp sell-offs. I mean, we had this in COVID. March of 2020 was one of the quickest and steepest declines, and then look where we were in June, July, and then 2021. We shouldn't be conditioned to these things, but the steepness of recovery has certainly been surprising.
Yeah, absolutely. I mean, look, the headline risk out there is real, and I think most of our viewers of our program know that, and especially our clients, they're working with advisors who we hope have a longer-term view for their portfolios that are well-diversified, et cetera. But obviously, it is good to talk about the immediate investing possibilities. And when we're talking about equities, because there's been so much volatility, where do you see places for investors who are out there they want to put some money to work, they're looking at the equity markets? Where's a good place for them to start to put that money to work today that feels like a decent spot that doesn't have too much risk?
Right. So we're looking for things that are very much in contrast to the current market. So we talked about uncertainty. We're looking for businesses that have more certainty in their future growth, their future cash flow generation, their future competitive advantages. We think that the market should place a premium on that certainty. So we're looking for companies that don't need the global macro economy to cooperate in order to grow. Companies that have more control over their own destiny. And so these businesses tend to be characterized by subscription or highly recurring revenues. They tend to be very deeply embedded into their customer operations. So maybe vertical market software, for example, that's mission critical and their customers cannot exist without them. That means they have low churn. They probably have pricing power. Sometimes these companies maybe seem a little boring on the surface, but we'd argue that's a good thing. If you own businesses of this high quality and high certainty over time, companies that generate significantly high margins, high returns on invested capital, you have materially, or you would materially have outperformed the market over the past 40 years to a degree of almost 60x. Now, finding these companies is challenging. Then holding these companies, to your point on the long term, is, I'd argue, even harder.
Right. And look, let's be real. The past performance is not a guarantee of future results, right? So there's no such thing as a guarantee in the markets. But that being said, when you're looking at some of these companies that you consider, as we had in that chart, high quality versus the benchmark of the S&P, what do you think about when you think about the words like durable and you think about predictable businesses? How does that play into your kind of investigating some of these companies?
Right. So we'll come up with a qualitative perspective or a thesis on a business, but that view, that perspective, needs to be validated by quantitative facts, if you will, or metrics. So typically, we're looking at companies that have revenue streams that are less cyclical than the average business. That means that the demand for their products is more durable than the general macro economy. So that gives us some sense of the recurring nature or the value proposition they provide. Then these businesses should take very high rents and show very high margins. We look at gross margins as a great example of that. And then returns on invested capital. Is a company generating a ton of cash, reinvesting that capital back in its business at very high rates of return? That's another characteristic. And then if we can find them, we prefer that businesses be capital light and can grow without spending too much additional cash. Those are the types of quantitative metrics that we love in businesses.
Yeah, I know. In your line of work, it's kind of fun to dig deep and look at into the sort of the bones of each of these companies and kind of figure out where their growth potential is and where the value sits. But that being said, look, there's still a lot of policy uncertainty out there right now in the world. Even as we're sitting here, there's some speculation from the international community about whether the U.S. tariffs are even legal. And so that's a broad summary of the news that we're currently seeing. But when you think about the average equity investor, where would they need to be putting their money to work, and what's missing in their portfolios? You know what I mean?
Well, I think what you'll find, we've been in a bull market since 2009. A couple drawdowns, but really it's been an incredible run in a very strong bull market.
2 years in a row of the S&P being up around 25%.
25%.
It's incredible.
I don't think that's happened since the late 1990s.
Right, exactly. Like decades worth.
Right. Phenomenal returns. And probably not sustainable.
Right.
The market goes up, 9 or 10% a year over a very long period of time. So I think that a lot of investors have kind of followed some momentum and followed what's worked, and you've got a fair amount of risk in the public markets in investor portfolios. You also have large exposure to what's worked. Tech, Mag 7. Mag 7's been a little choppier this year, to be fair.
Sure.
But it still makes up probably 30% of the broad S&P 500. That's a meaningful amount of capital. 30 cents on the dollar goes to 7 companies, and they're wonderful businesses. But at the size that they are, trillions of dollars in market cap, how long can that persist? And so we're actually finding a number of opportunities outside that large cap and certainly Mag 7 world, whether it might be smaller or data service businesses, or like I mentioned, vertical market software, or companies that are just not on most investors' radar, maybe have a bit more of a durable and defensive tilt to them, but still grow. We're finding a lot of interesting opportunities there.
Yeah, there's a lot of, we've talked about this on other programs, and we look at the SMID section, the SMID market, small and mid cap. There's a lot of AI adjacent companies. They might be making the microchips that a company like NVIDIA is buying, or Microsoft, or any of these bigger tech names that are part of that Mag 7. So it seems to be, and I think what you're saying here is that there is opportunity, and not even just in the large cap space. There are small and mid caps that have some value there, especially in that arena.
Absolutely. Companies that are maybe outside the public eye, maybe adjacent to some of these themes, but provide essential mission-critical products or services, have competitive advantages, and we're looking for those businesses that can compound. They might be a little bit more boring, but one foot in front of the other, earnings growth every single year, return of capital to shareholders, and a little bit of valuation appreciation over time is a recipe for really long-term outperformance versus the market.
I love that. I mean, as an investor, that gives you a little bit of peace of mind when you put your head on the pillow at night. Again, no guarantees of anything, but it's nice to know that there are, pockets of opportunity out there to make you breathe a little bit more, especially in this volatile period that we're in right now. Eli, thanks very much. I know we just got started with this conversation, but good to have you here. Looking forward to having you back. More here that I think we want to talk about.
Great to be here. Thanks.
Yeah, thanks. Eli Horton again from TCW. And for more information on anything coming out of UBS, specifically our Chief Investment Office and our great partners like TCW, make sure to visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on all the platforms, including LinkedIn, Facebook, and Instagram. You can check out our Instagram channel for the studio at UBS Trending. Lots of great content there for you. And as always, if you are interested in continuing this conversation, please make sure you're doing that with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.